Investing is a numbers game over time. I mean, that's what it really breaks down to. Reevaluate your property of, would I buy it today based on what equity and money into it I have? Am I going to get that return elsewhere? Am I better off selling it or owning it?
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. Hello and welcome to episode 223. Let's say you've acquired a decent-sized portfolio of rental properties. They're cash flowing, well-managed, and achieve your goals of long-term wealth. But maybe the cash flow you're receiving isn't enough to allow you to, say, quit your job or retire early or pay for that cruise ship vacation. However, there is enough equity in your portfolio to sell it for a substantial profit in today's economy. Is it time to sell and take your chips off the table? Or are you better served to stay on the buy and hold path that you set out on so long ago? Many investors are faced with this very question, and I have two of them in the studio with me today. My first guest is Ben Blake, and when he was last on the show, episode 149, he discussed his 12-unit Grand Rapids portfolio and why he decided to take over the management himself. Ben recently sold his entire portfolio, and today we're going to learn why. Ben, welcome back to the show.
Thanks, Brian.
Also in the studio is Jeremy Schumann, who owns 6 properties with 13 units altogether right here in Grand Rapids, Michigan. Jeremy is currently trying to decide whether he should hold or sell, and we'll be talking through that decision with him. Jeremy, welcome to the show.
Thanks, Brian. Thanks for having me today.
And friend of the show, Justin Workman, is joining us as well. Justin always lends a sobering and informed perspective on these types of decisions. And I appreciate having him here because I'm sure he will balance out my opinions.
Thanks once again, Brian. Glad to be back.
So Ben, let's start with you. You had a successful portfolio of 12 units here in Grand Rapids. You were managing them yourself. You were telling us how well it was going last time you were here, and then you decided to sell.
That's right.
Take us through that decision-making process.
So last when I was on the show, I had only been managing the portfolio for maybe 2 or 3 months. As that time frame progressed and I got settled in with the management, it was going very well. The cash flow had skyrocketed and everything was fine. But one of the things I had mentioned on that show was that ultimately I was looking for just mailbox money. I wanted the monthly cash flow with as little as work as possible. So around the same time, I had become familiar with a pretty regular stream of syndication opportunities. And when I did the math, I found that based on projections of these syndication opportunities, for the most of them, I could earn just about the same ROI through the syndications as I could with my portfolio.
So let me stop you. So syndication opportunities, these would be you if you invested passively in other people's investment opportunities.
That's correct.
You realize you could get the same returns that you were already getting.
That's correct. Within a small margin, yes.
And basically just have to do nothing.
That's exactly right. And so with that in mind, with wanting the true mailbox money, if I could make the same or maybe even just a little bit less money with zero work involved, I thought it was a good avenue to pursue. Not to mention the fact with the market conditions in Grand Rapids being as high as I can ever remember, tons of equity in my portfolio, that's when I made the decision to just liquidate all of it.
Okay.
And I've since taken all the proceeds from the sale of my portfolio and invested them into 7 different syndications.
Wow. Okay. So let's back into that. So with the investments that you went into, what kind of returns are you expecting?
So they all work in sort of a similar fashion. They project out about 5 years of returns. The first couple of years typically are a little bit lower, like high single digit, 7, 8, 9% returns. There's usually during that time they're doing a value add component, whether they're raising rents or leasing up different parts of the properties. There's a mix of commercial and multifamily. And after the value add component, there's a refinance component usually where you'll get a portion of your capital back. But then at that point, because returns stay about the same, but you have less money in the deal, so the ROI goes way up. So that's a long way of saying, for the most part, they're averaging somewhere between 13 and 14% return over a 5-year projection.
Okay. All right. So you were able to find some suitable opportunities that you were comfortable with.
Yeah, I found 7 good ones so far. There's a couple I've passed up on, but I still am getting a pretty regular flow of these.
And then just out of curiosity, as far as the cash flow that you're receiving from them right now, those monthly checks or quarterly checks, do they equal what you were making from your rental portfolio?
Not yet, because again, most of these are they start off the first couple of years are a little bit lower in the projections, and some of them they take some months, before the deal closes and they start pushing out the cash flow again. Some of them are quarterly, and some of them I just invested in, a matter of a month or two ago, so I've received no checks yet.
Okay, so it's early stage right now.
Yeah, early stage, but they all are tracking per their projections so far.
Fantastic.
Yeah.
All right, well, Jeremy, let's go to you. You have a portfolio right now in Grand Rapids, and you're trying to figure out what to do with it. Tell us a little bit about that.
So I'm vetting through the data right now to make an informed decision. Do I buy more, sell, or hold from that perspective? So I looked at my numbers in 2018. I'm going to give you some figures here. My ROI was 11.78% without the equity component. And with the equity component, I'm at about 18. So the returns are pretty nice. But when I look at those, they're inconsistent. It's not month to month to month is the same. So I'm vetting out the information to understand, can I get a higher rate of return? And I think my colleague over here, Ben Blake, spoke to options as in note lending or syndications or private equity, or can I put money into those investments and get as much or higher returns? So I'm trying to make an informed decision on different things and looking forward to say, okay, do I need to start accruing for roofs, the inconsistencies in the rental market regarding vacancies, how long are those going to be vacant for? Some of my homes are older, so they always need, I'm going to use the term TLC, always reinvestment into them to keep them nice, where we want to have a nice unit for tenants to rent. So as I go through kind of all those things in a mixing bowl, I'm trying to make an informed decision on what do I do in the future. So the first one I spoke to about buying in the market today, I bought mine within the last 10 years. You look at the market today, they don't meet my current ROI expectations, so I can kind of take that one off the table regarding buying more. So in relation to hold or sell, that's where I'm at today. I don't know where that could be potentially the top of the market for a sales price. So that's something I'm vetting out. And then hold regarding my returns are pretty good, but how do I go to my goal, which was, I think he spoke to it too, more of a mailbox money, I have to do less and receive more.
Mm-hmm. So it's interesting. So your ROI right now, just in cash flow, is what, 11, 12%?
Correct.
And that's based on the money that you have invested in these properties.
That's correct.
Okay, but beyond that, there's this whole equity portion, and you're saying that brings it up to what, 18%?
Well, when I say the equity play is because where I'm paying down debt, I put that in as I'm using the renter's equity, if you will, to pay down the debt, which actually increases my overall return when I put it in the calculation to 18%. So when you speak to the equity play regarding how much money I've left in the portfolio, there's a huge opportunity there, and that's kind of where I'm heading with my next decision-making process. So if I sell the portfolio, I'm going to walk with a large sum of money to invest. So that's really the question. If I'm at 18% now on a lower number, but I can invest that higher number when I sell at half that, I could be net. It could be the same, or opportunity to make more.
Okay, Justin, I'd like you to jump in here because you're good with math.
Yeah, no, and investing is a numbers game over time. I mean, that's what it really breaks down to. So just like when you purchase a property, you need to evaluate the property. So we go through this on a yearly basis. We evaluate every property. So we put in all the information. What was our income? What were our expenses? And come out with a total every year. So we can kind of judge that property compared to others and as we go through the process. The component to that most people don't consider is the equity earned. We are in a very high appreciating market today, and as you guys have known and as you're taking advantage of. So just to evaluate the property, it really is just like you're going to buy the property again. You have to look at it on an annual basis of, would I buy this property again, and what are the returns I'm getting off of this property? So what you have to look at is a sales price today. What's the property worth? So let's take a property that's worth, I don't know, even number, $100,000. Okay. Initially, when you bought the property, you put 20 grand down on the thing. And it cash flows, or it takes in rent $500 a month, or $1,000 a month. Cut that in two, you get $500 in cash flow. Out of that, you pay your mortgage, which would be $400-ish. Somewhere in that ballpark, so you're cash flowing $100. Sorry, I went down a tangent that doesn't make any sense, but we'll take that property. Well. Okay, so that $100,000 property you bought today is worth, let's say it's 150 grand. It went up, it appreciated $50,000. So now, in evaluating that property, if you sold it, you're going to have some sales costs. So say it's 10%. So you're going to get 135 grand out of that property. So minus the mortgage, which was 80 grand, you've paid down a little bit, not a big deal. You end up with, what's the number come out to be? 135 minus 80 would be 55 plus the 20 you put into it. So you got 70 grand, 75 grand invested into this $150,000 property. So when you're calculating your return, you really need to factor on, I've got $75,000 making $500 a month. Or, or $100 a month, whatever that cash flow number is. So it gets a little more in depth when you go to buy back, because you've got to add that equity component into that investment. So when it comes down to evaluating the property, it's not what did I pay for it, it's how much equity do I have into it. And that's what you're evaluating your return on, because the equity component is there. And it's something you do need to factor in.
It sounds like, Jeremy, that you kind of factored that in. Are you factoring your equity component the same way that Justin is?
I am not. So I need to clarify. Maybe I need to apologize because I used the term equity earlier. I'm using like the owner's equity. So when I say that is like it's the money that I'm paying down on my debt. So I'm adding that back to what I owe. So, but I am not calculating the equity at which the property has appreciated.
The appreciation.
Correct.
Yeah, because you have to treat an investment as, am I going to buy it today? And that's the way you've got to look at it is, am I going to buy it today based on what I would have to put into it, which is essentially what you've got an equity into the property and the returns that I'm getting out of it. So in today's market, let's just say real estate's going anywhere between a 6 and 8% return for most investors, average investors that are out there. So is that property meeting that 6 to 8%? Is it doing better or is it doing worse? And that's the thing that you really have to look at. And projecting that year over year kind of helps. Now, we can't always factor appreciation. It's nice and it's been great while we've had it. Is it going to be around forever? Who knows? But that's why if you do it on a year-to-year basis, it helps build kind of a track record and build a true performance of your properties. And it's nice to compile them in a spreadsheet every year too, because you can compare and you can look at a 5-year average of, well, this property is doing worse than all of my others. It's time to just dump the thing and move on. You can really evaluate them better that way. Again, there's a major time component that's tied into this investing world. So if you just take a property and you look at it at the end of 1 year, well, maybe you had a vacancy, maybe you had an evicted tenant, there's some additional expenses there. You had to dump a bunch of capital improvements into it, whatever the case may be. It's not a long enough track record to truly evaluate its performance. You've got to expand that timeline as much as possible. So if you can do a 5 or a 10-year study on them, you'll find out what the true average is, because you're going to have some down years. That's just how it goes with any property.
Well, Ben, I'm curious in your case how you looked at it. Obviously, you felt that the equity that you could pull out could allow you to have kind of the armchair money coming in, or the mailbox money that you call it coming in, almost at the same rate that you were making with your portfolio.
Yeah, so I calculated ROI maybe a little differently. I always calculated ROI based on my investment in the property. So the amount of cash that I outlaid, which basically was down payment closing costs and capital improvements.
Yep.
And I took that figure divided by my cash flow, and that was my ROI. I never sat down and said, well, and use the equity piece as a part of the calculation.
Yeah, which is what most investors do. And what it does in an appreciating market is it really hurts your investment, because now you have more money tied up into this investment. Mm-hmm. So your ROI should somewhat go down as far as on a cash flow basis. But as an overall investment, it goes up because you've added that much equity into the whole thing.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com.
When I did my calculations based on how I did ROI, I was in like the low to mid teens, and then found with these indications I could make low to mid teens cash on cash. So it was kind of a wash for me. And the other thing, a comment that I had, what you said before about these, when you have turnovers or you have a city inspection or all this stuff, it created such wild inconsistencies. Now, granted, my cash flow was fine if you average it out over a month, but the inconsistency I just really hated. And I find that there's a greater improvement with the way I'm investing now. And again, just none of the headaches that go along with being a landlord. So it was kind of a win-win, and it made the decision pretty easy for me.
Yeah, Jeremy. So when you hear the way that Justin looks at it, does it change your perspective at all?
It does not, but I would ask Justin what are your assumptions? Are you basing your data based on a 15-year mortgage or a 30-year? How do you calculate that? Because that does change numbers quickly. And I based mine off of 15 years. So I look at mine as I was trying to pay these off as soon as possible and, create mailbox money and retire type deal as soon as I could.
I'm sorry. I also have another question. You may be able to answer this. How are you factoring, when you're calculating your equity, are you doing like a BPO, just a regular market value, using Zillow? Are you doing a cap rate, or how are you figuring your values?
Okay, we'll answer both. Sorry.
I know Brian's the host. Yeah. Brian's supposed to ask the questions, but I'm curious.
I like Justin doing all the talking.
As far as determining value, it's a market value. So if it's a multi-unit apartment complex, you're going to figure it based on a cap rate. You know, what could if I put the thing on the market today, what am I going to get for it? I mean, that's what you're determining value on. It's not a necessity number, it's not a pie in the sky number. You're just trying to put an actual value on the property of, if I listed it today, what would it sell for? So whether that's a single family house, you're going to use a comparable market analysis or a BPO, something along those lines. But if you're selling an apartment complex or commercial building, it's based on a cap rate. So those numbers vary, and how you come up with a value varies, but you want to be realistic. This isn't to make your portfolio worth way more than it is. It's just a reality of, okay, if I sold this property this year, what can I reasonably expect I would get out of it? That's really what you're after when you come up with value. And same thing, you're just trying to base the decision on, if this property was for sale, would I buy it today? And that's what it comes down to, is if this was on the market and I walked through it, would I buy this property today based on the projections? And the nice thing is you have a history of those projections.
Would you buy it today at today's price?
Yes.
Okay.
Yes.
And what if the answer is no?
Then you should sell it.
Because now you have all this equity tied up?
Because now you're purchasing a property with a lower return than you could expect to get elsewhere.
Well, no. I mean, you'll say no about buying it, but if you actually own it and you're asking yourself that question, and you say, no, I would not buy this today. Well, that's all my entire portfolio. The answer is no, I would not buy it today. So are you saying I should sell everything?
If you can reasonably expect to get, let's say, a 10% return elsewhere, I can deploy my capital and get 10% returned pretty much guaranteed, and the property you're looking at is only giving you a 6% return, why would you own it? Shouldn't you then sell it, deploy that money, and get 10%? It's strictly from an investment standpoint. There shouldn't be an emotional attachment to it. And I know that's difficult to do.
All right. So
Brian, you have to sell now.
Yeah, I expected Justin to come in here and be the buy and hold guy.
And I am.
And what you're saying is no, like sell, because most of anyone who's bought your portfolio is what, like within the past 10 years?
Plus or minus, yes.
So you've had a huge appreciation during that period. So I expected you to say the opposite of what I was going to say.
No.
And say, no, you buy and hold, you take care of it, and it'll see you through retirement. But now you're saying, no, all that equity that's pent up in that portfolio, you should sell and take that off the table and put it into something that's going to get you equal or better returns.
If you look at it from strictly an investment standpoint, and that's the way you feel the market is, then yeah. Where I have properties, I see some other potential yet for more returns. And I have properties that if I sold my current property and bought the one next door, my returns would be the same. So in that case, why would I sell it? You've got to look at it in a market analysis kind of situation where it's, if I sold house A, can I buy house C and do better? And the answer in most cases is no. House C is going to do as good or worse than house A would for me.
I think a vital component to what you're saying, Justin, correct me if I'm wrong, is if you have another investment somewhere else where you can make more, then absolutely sell it. Yes. But if you can sell it and that money's just going to sit there making nothing, then
it does you no good. Exactly.
I'm tracking with you now.
So if I am strictly a real estate investor, I only buy real estate. Am I going to sell house A that makes a 10% return and buy house C that makes an 8% return? No, I'm not going to. My 10% is better off. Am I going to sell house A that makes an 8% return and buy house C that makes an 8% return? No, it's a wash. Why would I go through the hassle and headache of buying something I don't know and how it performs and how it tracks?
But is that an 8 or 10% return based on just the money you have into it, or also the equity, that appreciation that is built up?
Again, you have to treat it as if you're buying the property today. So it's all of the equity that you have built up into this property. And again, it's different from my standpoint because I'm mainly a cash investor. So I don't have mortgages lying around that I have to factor into these deals. So my returns are going to be different anyway than a lot of people that have invested with mortgages.
Okay, let's take a look at Jeremy's portfolio here and get us. I mean, if you don't mind sharing some numbers with us.
Sure.
You know, how much money you have out of pocket into these.
Can we just pick one property?
You want to just do one property?
Is that fine?
Yeah.
Sure.
Well, whatever's easier for you, Jeremy, because we could take it all as a whole or just one in particular.
Justin got the calculator out.
Yeah.
All right. Yeah. Oh, the calculator's
I know.
on the table.
I need it.
It's on the table. Okay.
I can only do so much math.
So give us an example of one of your properties then.
Well, I have when I say I have multiple properties, I have some that are paid for and some that are not. So I assume you want to talk about maybe one that's not.
Let's talk about your best one. Let's talk about the best one, and maybe you've had a huge appreciation in it.
Yeah, just give us a property address. Throw it, or sorry, not a property address. Just give us a property.
Sure. So I have a property that I bought it for. Let's do some math here. $215,000.
Okay.
It is. Per the ROI, my current returns are north of 20% right now on my investment. That property now, as I'm told, is per market analysis is worth $525.
The property today is worth $525. What does it get in rents on a monthly basis? What does it collect or should collect?
You're going to work off the $525 current valuation.
Yes, we're going to just. What does it make, or what are our gross rents per month?
Gross, we'll just do some simple math. It's about $3,800 a month in gross rent.
Okay, so if we take $3,800 and multiply it by 12, it comes up to $45,000, roughly, $45,600. We're going to divide that in half. We're going to just make the assumption that 50%
expense ratio.
Yes, is the expense ratio. So that leaves you with $22,800 a month in cash flow more or less, excluding mortgage and principal and interest and that kind of thing.
That would be a year. So not a
Or
month.
per year, sorry. Yes, per year. So if we take that number, that $22,800 a year, and divide it by the 520, we've got to figure out what you have into it, essentially, what your actual cash is. So we've got $525,000 is the value of the property. What did you put into the property initially, down payment wise, capital improvements, initial investments?
Right. So you have the typical, 25% of the buying price at $215,000. So you're at about $55,000.
Okay, so you got $55,000. Any major capital improvements?
The norm, we'll call it, regarding the city inspections, painted the property,
Okay. So
but
just maintenance, more or
maintenance,
less.
nothing major.
Not like you
Correct.
put new roofs in, parking lots, anything like
Correct.
that. And your mortgage, you said, was a 75% mortgage. So on 200,000 would be 150,000 ish, something like that was your mortgage.
Correct. To start with, yes, correct.
So per this property, if you could sell it at 525, the only thing we didn't include in there, which we should add, is cost to sell. So let's just put a 10% cost to sell in. So at 525, it would be $52,500.
And cost to sell would be like realtor's commission,
Realtors fees.
transfer taxes, and et cetera.
So we have $320,000 more or less in equity, minus the $50,250 or $52,500 in essentially closing costs to get rid of the thing. So you have $267,000 essentially in equity or invested into that property. So what it comes down to is, would you put $268,000, we're going to call it. So we said there was $22,800 a year is what it brings in, divided by the $267,500 would project this property at an 8.5% return on your money. If you can follow all of that crazy math, essentially you've got 250 grand in and it's making 8% a year based on those returns.
That's interesting because when I did my calculations, and I spoke to those earlier, 11.78% and the additional with the owner's equity, I don't calculate it that way. I calculate their ROI based upon kind of what we talked about earlier, what I have into it divided by what I'm making per month, just strictly cash on cash. I don't.
Yep.
I see the math. I understand the math. So it's different math. Not saying it's wrong.
No.
It's just different math regarding 8%, 8.5%. I'm looking at your calculations.
So the way you're calculating it is you have, what do you have, about 55,000?
Yeah, 55.
55 into it. And how much are you making in cash flow a year?
22.8. Well, minus the mortgage
minus
payment.
mortgage, though. So
So 22.8.
But that would be correct based on cash. If
What's
you're
your
doing
mortgage payment a month?
I'd have to look. $1,800.
So in that case, you're making $1,200 a year on the thing.
$1,200 a month. 44.
come up
It'd
with a
be
year.
44,000.
1,800
14,400
times 12 would be 21,600. If we do a 50% expense ratio, it makes $1,200 a month or a year.
Yeah, the expense ratio of 50% is much higher than.
than reality. Probably the tenants are paying their own utilities,
That's correct.
and you're just paying water.
Correct.
You have no
But-
snow removal, you have no lawn fees, so
No.
your expense ratio isn't quite as high, but still.
Correct.
But it goes back to kind of the same statement of, okay, right now in Grand Rapids, properties are selling between a 6 and an 8 cap. So you're getting a 6 to 8% return on that cash invested. And this property is doing slightly better than that based on wild assumptions of the 50% rule. So if you paid all cash for the thing or based strictly on just your cash invested, it's performing better than the market. Now, it does get tricky when you start factoring mortgage and stuff into it.
So the reality is on that property, I just broke up my calculator. I make about $1,000 a month off that from a pure cash flow perspective. And I put, we use the number $55,000 in. So 12 divided by 55, it's about 22% according to my quick calculations.
That's what I get to. So you're
As far as a cash on cash return.
Correct.
Yes.
22%, and you're so okay. So your making 22% on the money that you actually have into this property. But based on your calculations, Justin.
But I would change your calculation. Again, if you're making $1,000 a month, you have $270,000 in equity into the thing.
Correct.
So it really should be $12,000 divided by that $275,000. And in that case, you're only making, I skipped a zero, 4% on your money.
On the actual, that includes appreciation, money into it, appreciation.
Yes.
So if I heard what you're saying, I heard you earlier, and a lot of things are based on assumptions, because I know that Ben talked earlier about making a different number. We talked about 10% earlier. Mm-hmm. So if I heard you properly, we use that assumption that we want to make returns of 10%. You're telling me I'm only making 4.3 on that money. I should sell that property, take that money, invest it at 10%.
Only if you can guarantee you're going to make 10% on it. Now, we're factoring just cash returns. The other side of the coin, especially in today's market, is you have an appreciation side. So theoretically, if we're again going to appreciate at 10%, now that $500,000 property just gained you $50,000 in returns on top of, whatever you included in rent. So that's the part that gets a little more complex as well. So now you are making $12,000 a year off of this property, but you've added $50,000 in appreciation. So now you divide that by the 275. It'd actually be 325 because you added the $50,000 in appreciation. Now you're making 19% return on that money. Which just because of the appreciation rate.
I understand the math on that, but I guess the number, again, we're kind of talking about assumptions here, and I guess I get a little gray with those because can I get 10% guaranteed? That's a question mark. That's an assumption.
Yep.
The other question is, at what point do the properties, 10% or whatever number we want to use for appreciation, when does that top out? Because we're in Grand Rapids right now, and Ben sold his portfolio because he felt we were close or near the top of that. And different projections say that we're nearing that. We may plateau soon. So I'm hearing everything. I'm a mathematical guy. I feel you on all this, and I want to make an informed decision, but it's all based on assumptions that go toward the term I feel almost. And I'm a black and white. I'm an engineer, by the way. I'm a black and white guy. I want to make things black and white. So how do we make them black and white? How do we make assumptions real?
And I think that's where you have to go back to historical averages. Okay. If you look at long-term real estate appreciation, it's about 6%.
6%
annually.
A year?
Yep.
Appreciation of 6% a year. That's a historical.
Yep. If you look at like a 50 to 100-year track record, it's 6%. So I think that is a fair and safe calculation. Now, again, we need to look long-term. This is investing. This isn't, I'm going to buy it today and I'm going to sell it next year. That is flipping. There's a difference between the two. So if you project out a 6% appreciation rate, I think personally Grand Rapids is going to be higher than that in next few years to come. But that's kind of our historic average.
Wow. And then don't forget tax benefits too. You get the depreciation and the tax benefits of owning the property.
Yep.
Which you quite often get in syndications as well. If you're investing passively, you'll get the tax benefits. But I'm not a engineer like you guys are. I'm a little confused as to where we landed on this. It sounded like at first he should sell, but then you did, once you factored in the 6% appreciation, and now it's sounding more like he should hang on to it.
And that's part of the equation. We tell you when you buy these things, don't factor in appreciation because you don't know if it's going to happen or not. But when you actually do an analysis on it at the end after you own it, I think you should factor it in. And if you're going to hold it for any amount of time, you're going to own it long enough to weather the storms. So you're either in or you're out kind of in the investing world. It's not a wishy-washy thing. You're either going to buy and hold it and own it, and you're going to, expect to get that appreciation rate, or you're going to try to play the market and buy low and sell high. There's different options. But yes, I think if you were to go out and buy this property with cash, it's earning about an 8.5% return. So it's an 8.5 cap, more or less, based on our calculations. If you factor the appreciation rate in to what you've already invested into the property, it's factoring out at like a 19% return. So can you do better than that 8.5 cap or better than that 15% plus return? And I think that's the questions you have to ask yourself. When is it time to sell? Yeah. And again, it's not this was a good year. I didn't have any vacancies. I didn't have any turnover. I didn't have any major repairs. You've got to evaluate it over a track record. And
right.
over
and you may not have that $12,000 a year in income because maybe you have to put a new roof on.
Yep.
And you have to put money into the property one year. So you're not going to stay consistent on that.
No.
Now, using your example, I will tell you how I made a decision recently, within the past year and a half, to sell one of my 4 units. And that was, I looked at what I was receiving in cash flow for the year, and I compared that to the money I could actually pull out and put in my pocket. And I can't remember exactly what those numbers were, but in your case, you're making about $12,000 a year. And how much did we decide Jeremy could pull out of his property?
$275.
$275. So how many years would it take you at $12,000 a year in cash flow to make $275,000? And when I looked at it with my 4 unit, it was about 18 years before I'd make that much. And I made the decision in that case to just take that money off the table and put it into something else.
And that's where I struggle today, or that's where I'm vetting out today to make that decision. And obviously Ben Blake to my right, the legend that he is, he already made that decision.
All right, yeah. So Ben, you've been down this road. You did all the calculations. How happy are you with your decision, and do you feel like you're making a better return now?
I would say returns are probably comparable, but in the grand scheme, it's better because I have zero work. Mm-hmm. All I do is look at my monthly statements. So I have zero headaches. I have zero work. And the other side of it is, I was a very new landlord, by no means an expert, learning a lot. I've invested with some world-class operators, and so I know that the properties are being taken care of by absolute professionals too. So there's that peace of mind as well. I sleep really well at night. So yeah, I think I've made a great decision relative to where I was with my portfolio.
Yeah, because there is that emotional toll that real estate can take on you. Even if whether you are managing yourself or not managing yourself, there's the citations and violations from the city that personally drive me crazy. There's the unexpected repair and maintenance items that come up, frozen pipes or whatever. And I've had you name it, I probably had it on my properties. So it is sometimes hard to sleep well at night because you're worried if it's raining and there's a big storm. Is there a tree going to fall in my building? Or
the tenants never call you with good news.
Yeah. Luckily, I don't talk to tenants, but
and your property manager rarely calls you with good news. Yeah, unless maybe they leased a unit or something like that. But the calls are usually not good news, so I don't have those anymore.
Yeah. What about you, Jeremy? Do you have those issues?
To speak to some of the things that Ben brought up, yes. So I do some of my own maintenance. I do to cut down some costs that help. I do some of my own landscaping and yard work, things like that. So there are some headaches involved. I do have a property management company that runs my facilities. So overall, I'm fairly hands off, but I do like to stop by when I mow the lawns. It kind of gets my way of keeping my hand or my finger on the pulse, if you will. So, but I'm looking at, as I look down this path, I want to be more toward the mailbox money also. So it's kind of leaning me in one direction. Now I have to go back, do some new calculations based on Justin's mathematics. So there is an emotional piece you talked about. So I've done a lot of work on these properties. I've painted them, I've rebuilt them, different things myself. So there is that kind of owner's piece, and there's that emotional piece that's part of me over there. I cut my finger on that one, or I smashed my thumb on this one, or memories, things like that, in a good or bad way. So it's difficult. This is not an easy decision. This doesn't quickly be made and gone. And that's why I'm trying to make it black and white. And that's why I'm pulling the audience today. I'm learning and listening to these two experts to my left and my right, and yourself, Brian, that have made a decision based on data and understand the next level of it. But I kind of look at other things as, okay, the housing market, the real estate market, and I'll call it that, of rental property is like a first step for me. So what's next in my journey in real estate investment? Is it bigger apartments? Is it commercial properties? Is it what's next? And so I kind of look, this is my dabble and my toe in the water. Now I want to grow it because I want higher returns. I want less headache, but I like the real estate piece.
And it's not just what's next, but what is the goal? What is the ultimate goal? Is it true passive income? Because, Justin, I don't think anybody can own rental property and have truly passive income.
I'd agree with that completely. I'm heavily invested in the day-to-day operations. I do everything myself. We self-manage. We do all the repairs. We do all the rehabs. So it is my life. It is my business, So it's a little different. And I don't have the goal of being completely passive either. I like to be involved. It gives me something to do. It gives me a reason to get up in the morning and go out and do something. So it depends on what your goal is, what you're looking for, what you're trying to get out of this investment.
So, Jeremy, I'm curious if there are other decision-making factors that we have not talked about yet.
So I think we spoke to it briefly earlier, was the assumptions. I think that's always a difficult piece for me because I like real estate. I like that piece, and I want to get the same returns, perhaps bigger somewhere else. So the assumptions that you have to make or part of these calculations are, where can I invest that money somewhere else in the real estate space? Be it be syndications, which Ben is obviously a big fan of, note lending, which is we haven't really got to that part, but it's still real estate based because you have asset based. Or something to that effect, or private equity to where you can put some money into another commercial building, we'll call it, but it's still real estate based. So where I struggle is, where can I take the money and Justin talked about guaranteed 10%. That's always but is it 8? Is it 6? Is it 5? What is it? Because if you can't get those returns, then I should hold, right? And Justin spoke of 6% appreciation. So I don't know. I mean, it's always assumptions that where's the market going to go and what are the returns?
And it's interesting to change the subject slightly, but we all started investing in real estate for specific reasons. Whether it was kind of build a buy and hold portfolio, or do the Robert Kiyosaki Rich Dad, just like invest our money in assets, real estate assets, as opposed to the stock market and all that. I'm curious with all of you, like, what was the original reason you guys started investing in real estate? And I'll start with you, Ben.
I started investing really just to grow wealth. And I was turned on to it by, you just mentioned Rich Dad Poor Dad. That was the first book really I ever read. And that turned me on to real estate. More so, I don't know if it was real estate as much as I just did not understand the stock market at all. And really at the time, I saw two options where I could put my money, either real estate or stock market. And I felt like with real estate being a real solid, tangible asset, that was, I'm not going to say no lose, but it was much safer, if you will. And so that's kind of what triggered my interest in real estate.
And as you set out to build your portfolio, and you had up to 12 units, when you bought them, were you thinking, I'm going to hold on to these forever?
Oh, yeah.
Or I'm going to buy them and then watch them skyrocket in appreciation and then sell the whole thing?
Oh, I still have, so pretty much on an annual basis, I'll print out my goals and tape them to my wall or my marker board or something. And I still have some from 5-6 years ago where I had projected out that, I don't know, in 10 or 20 years, I was going to have 100 units. That's where I wanted to get. I wanted to build it that big. And like we said before, like over time, things change. Markets change, our investment goals change, our willingness to dedicate time to these things change. And so, yeah, originally I was going to have this massive portfolio, and I'm not ruling that out forever. Just right now, that's not the right fit for me right now in my life.
What about you, Jeremy? What was your goal when you first started building your portfolio?
Sure. So a quick story how my real estate life started was a previous boss of mine had many units, and he said he was going to sell out because I forget the reason why he was tired of them or had other things that he was going to focus on. And he goes, I'm going to keep this one, and it's because it was really easy. And I said, I'll buy that one. So we made a deal, and I entered the real estate market just because it was kind of on a whim. It was kind of a conversation. And then it grew to where my plan or goal is to make $5,000 a month so I could retire on that, live on $5,000 a month, and never touch my 401k. Well, then I got my toe in the water, and then I started growing it, and then it became much bigger. than it is, okay, how do I mimic my friend Justin over here and do this for a living and have it passive income to where I don't have to work. I can just manage these things and life, sunsets and beaches, everything else type deal. So, but now as we look at here, I look at now the numbers, because I'm a numbers guy. I look at the numbers and I said, is it time to do something different? So I'm still asking myself that question today.
Yeah, so reevaluating, but looking carefully at the numbers. And Justin, what about you? I mean, what are your goals and dreams?
I don't know. I think they've changed over the years. Originally, I got into this as an investment. I truly did. I loved my job. I loved what I was doing. And as I continued to go, life happened and caused me to make some changes. And that's when I dove into real estate full time and a little more heavily into it. And have continued to just grow along the way. In today's realm, I'm not buying properties like I once did because the returns aren't there. So I am looking at other investment avenues. Because there's money out there that needs to be deployed in some aspect. So where can I get those returns? And for me, it's not in my wheelhouse, essentially, for the most part. I can't buy a rehab property and make money on it like I used to or like I would expect to. So I'm not doing a lot of rehabs these days. And that's just the way the market goes. So I'm looking at other avenues, looking at other opportunities, look at other business ventures. All of those things kind of tie into my daily life at this point, but it's been a fun journey.
You evaluate your portfolio every year. Are there properties that you would sell off based on the calculations that you just gave us?
Yeah, and there are, and I continue to sell some. I was given great advice is every year at least sell off the worst property. Because what it does is it forces you just to get rid of it. And you find it frees up some of that mind space too, of if you get rid of the worst one every year, you're selling off something that you really didn't care for anyway. It's not making you that much money. Just get rid of the thing and be done with it. And so I've continued to do that all the way through. And I keep selling stuff off. I just am not buying as fast as I once did.
It's interesting how advice sticks with us. Because that's very good advice, but I've heard opposite advice from early on that has stuck with me, which is don't ever sell. Mm-hmm. And there's people who are adamant, you're going to regret it. Don't ever sell. And they talk about properties that they sold and they drove by them and they've gone up in value and they wish they still owned them. What do you guys think about that advice? Obviously, we just had a whole conversation, but do you ever feel guilty? Do you ever feel guilty that you sold
advice? No, I don't feel guilty at all. Mm-hmm. No.
And do you stay up at night, Jeremy, like thinking, oh God, because that advice, it's like that, it sticks in your head. Do you have that in your head, like I have in mine?
Well, I don't. I think it's a month to month, and there's certain cases where you get cited for a city violation, or you have to do an inspection or whatever it may be, and it's like I should have sold that a year ago, or I mean it's based on numbers. So like this last month, maybe you didn't make any money. You're like, I should have sold that one before I had to dump a bunch of money into it, or that property is a ticking time bomb, or the other piece is it's. Okay, what's the top of the market? Is there still more value left in that one? I should have held it for one more year, and I could have made another 6 to 10%, what Justin alluded to in appreciation. Where is the top of the market? Where is the bottom of the market? And I mean, so there's so many factors that I've lost some sleep. I mean, let's be honest ourselves.
You want to jump in, Justin?
Yeah, I can comment. I mean, I look back and you take the advice, you should never sell. Well, if I didn't sell, I started, essentially with nothing. I put $12,000 into a bunch of lots, sold those lots to buy my first rehab project, sold that rehab project to buy another one, sold that one to buy my first rental and then another rehab and so on. So if I didn't sell along the way, I wouldn't be where I am today. So to take the mantra of never sell, I think it's bad advice. Because you have to sell to move forward in some situations. And that was my case. I was selling to move forward. I was selling to gain more equity, to cash in some of that hard work so that I could go forward and buy more. Are there deals that I passed up on that I wish I wouldn't have? Sure, but I passed up for good reason at the time. You can't live in those regrets. You can't relive those situations every day. You just have to move on. There's chances that you take and there's chances that you don't. And I think you've just got to move forward. And that's why I think evaluating, would you buy the property again today, I think is a good stance to look at it of. If it was for sale for X, would I buy it based on my projected returns?
Yeah, and maybe the real answer to should I sell is yes, if you can redeploy that money into something that's going to be better. I mean, at its core, like I think we all agree on that. If you can do better, then by all means sell.
Or if it frees up your time in your life, you sold because you were sick of the property management aspect and it was a time to get out, and it freed up so much of your life. And I can understand and I respect that a lot. Because managing properties does take time, and it does get those phone calls late at night. And
yeah, I wouldn't say I was.
News is not great news on a normal
I wouldn't
case.
say I was sick of the property management. It really wasn't that hard.
No,
I just when we evaluate our lives on a daily or weekly or yearly basis, whatever, I just realized that wasn't something that I wanted to do forever.
Yeah.
So yeah, that definitely did help.
Yeah. So I want to wrap it up, but I think one last good question to go around the table with is where we see the market today and what we expect coming up. I mean, we're recording this in right before Thanksgiving of 2019, and this will probably come out in March of 2020. What's our perspective on the market right now? And Ben, I'll start with you.
Probably good to start with me because I already sold and I have no choice in the matter.
It sounds like you felt that you were at the top of the market and this was the time to take your chips off the table.
Yeah, I did feel that way. My feeling wasn't anything scientific really. It's just I listen to a lot of podcasts, I read a lot, and every time I turn a page or every time I listen to a new podcast, whether it's on real estate or in the economy in general, everybody is saying looming recession. Everything that's going on in the bond markets, historical indicators, all this other stuff says recession is coming. And nobody has really said that means we're going to have another 2009 in the real estate market. But an economic downturn just led me to believe that now would be as good a time as any to sell. Did I take the risk of maybe over the next couple of years or who knows how long of appreciation and maybe missing out on that? Sure. But getting out now, I knew I was able to get what I wanted out of my properties. So that's really what helped me make it.
All right, Jeremy?
Sure. So I'm vetting that out right now, but I think that, especially in the market we're talking about, Grand Rapids, I think that we are, it's been climbing so fast, so steady that I feel we've got to be getting close to the top of that. Now, is it going to be plateaued, and that's fine, and that's where it is? I can't lose in that deal, or I could lose because it could grow. So overall, I think we're getting close to the top of that. Economic indicators kind of say the same thing that Ben spoke of. But I'm just curious, Ben, though, you talked about recession, but then you went and bought in syndications. Isn't that buying property again?
Very strategic, different markets. Everything I've invested in has value add components. And so I think that those are very sheltered from recession. And if I could add a little bit more piece, I do think that Grand Rapids, our specific market, is probably a little more sheltered from the rest of the national economy anyway. But I guess I would say that I didn't really take that much into consideration with market conditions. I just knew that it was as high as I'd ever seen it, and I knew I could get what I wanted out of the properties. So I don't think that investing in real estate now is a bad idea because of a potential looming recession. Like you said, that's exactly what I just did. I turned around and put all my money in some commercial stuff, mostly in the southern states. I thought the money was better deployed there.
I just want to comment on that. I think the only hiccup in that plan, and that's what scares me the most right now, is I'm good with the very short-term stuff within a year, and I'm good with the long-term stuff because the economic indicators are out there. There is a recession looming. The hiccup in the syndication stuff right now is, can you do a refi in 3 to 5 years? I think that part for me is scary today because what's the market condition going to be? What are lending requirements going to be in 3 to 5 years? And I think that's a big unknown. So that's one factor I'd take in as you're looking at these syndication deals. As far as our Grand Rapids market goes, I've changed my tune a little bit. I mean, I remember sitting down probably right here 3 years ago when we talked about, well, the market's going crazy. We've got to have a downturn. It's going to be coming. It's going to happen. This can't go on forever.
And it never came.
And it's never come, and it's continued to go on and keeps going on. And the more I've talked to people over the years, the more I've realized Grand Rapids has become a global place to invest. You talk to property management companies that are out there, they're getting millions of dollars from all over the world to invest in Grand Rapids. So I think as far as our real estate market goes, our returns are not what they're used to. They're going to be lower because of this outside money coming in. But on the plus side, the world views Grand Rapids as a very stable market. And with that money coming in, I don't see our real estate market going anywhere at this point in time, at least not in the near future, in the next 5 years. I can only see us continuing to grow and continuing for appreciation to go up. We may have a slight plateau and we may not appreciate as fast, but there's so much outside money moving into Grand Rapids right now that our investment alone is not going to change that. So I feel our Grand Rapids market is extremely strong, is going to continue to grow, it's going to continue to build, and our property values are going to go up. The downside of that is I feel we're reaching a plateau as far as rents. So our property values are going to get higher, but our rents are only going to increase so much. They're not going to rise as fast as our appreciation rate. So again, our returns on our investment are going to be lower based on higher cost in, lower returns on the rent side. But I still feel it's a very strong market to invest in. I think there's a lot of opportunity out there yet, but again, the returns aren't as high as they were 5-10 years ago, for sure.
Since I started investing in Grand Rapids in 2008, we've gone from being a tertiary market to a secondary market. And that's had a huge impact on just the values and appreciation. And in any recession, in any economy, real estate is always location specific. So there are plenty of cities and places to invest in Michigan that have not seen the appreciation that Grand Rapids has not seen the rent increases that we've had. And I've invested, or looked into investing in those areas and really realized just how special Grand Rapids is when it comes to investing in real estate. So as far as the recession that we all feel is going to happen at some point, I do think it's going to be somewhat of a blip here in Grand Rapids, but it will probably be more of an earthquake in other areas. And then going beyond that, I would not be surprised to see as Grand Rapids continues growing, adding jobs, businesses moving here, to see real estate. We'll be looking at this episode 5 years from now and saying, wow, things really took off from there. Even though the four of us right now would find that hard to believe. But I think Grand Rapids has a lot of room to grow, and I would not be surprised to see that happen.
And I'd agree with you completely. I think we're still in the beginning stages of growth in Grand Rapids. I think we are a diverse enough economy where we are going to feel it a little bit if we do have a recession or a downturn, but it's not going to hit us like other parts of the country.
All right. Well, on that note, I want to thank all of you. Ben, thank you for sharing your decision-making that went into selling your portfolio. And Jeremy, I hope we've helped you, at least given you some guideposts to look at as you decide whether or not you should sell your portfolio. And Justin, thank you for bringing your calculator and wowing us with your number skills.
No, it gets messy, and I know it's hard to listen to through the podcast, but just reevaluate your property of would I buy it today based on what equity and money into it I have. Am I going to get that return elsewhere? Am I better off selling it or owning it?
Next time we need a spreadsheet and a projector.
I know. We can do that.
We'll do a live webinar. Well, thank you, all three of you. It's been a lot of fun.
Thanks for having me, Brian.
Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.